Hello, everyone. I'm Brad Long, Partner and Deputy Chief Investment Officer at Fiducient Advisors. Today, I'll be covering our third quarter quarterly considerations. There's no shortage of things to talk about in global markets today, so we're going to be going pretty quickly, and we've got quite a bit to cover. We're going to attempt to cover three things. One is a little bit of the what happened in Q3, where that's left us year to date. The why, what is the thread that's pulling all this together, and what's driving markets today. And then the where do we go from here? What's our outlook and how does that impact our portfolios? So unfortunately, our compliance and legal team couldn't be here today, but they wanted to make sure we had a few disclosures on the way in. All right, let's get into it. In Q3, you can see a lot of proverbial red on the screen here. Circular dots are Q3 returns, bar charts are year-to-date returns. And you can see the majority are below the line, some of which materially so. Dark blue is fixed income, gray-ish, call that gray, is equity, and light blue are real assets. We'll get into the specifics on each of these, but suffice it to say, the fact that all of these are down, kind of down at the same time, has been an uncomfortable environment for investors, specifically around fixed income. And actually, if we were to close the year today, well, this is 9/30 data, it would be the worst year on record since 1972 for the Bloomberg Barclays Aggregate US Index. And so that has had a material impact on both portfolios and investor psyche as they've been thinking about portfolio construction and volatility. So as we unpack some of these, we'll first start with fixed income. Fixed income, the number one kind of by far and away factor that's been influencing year-to-date returns has been interest rates. Interest rates, I think as many know, as interest rates are increasing, bond prices are often acting in the reverse and they're decreasing. And so elevated market volatility has really been around, well, the root of the problem, inflation, then the inflation police, right, the Fed, and then price volatility. So you can see this, let's call it mustard. I'm colorblind, so give me some lenience. 9/30/2021 US yield curve. There's two things. One, obviously all the numbers are materially lower. And then the second is you can see it's positive sloping or upward sloping. As we look at the dark blue here, we can see that those two things. It's a materially higher figures, right? So interest rates have gone up. That has meant bond prices have come down. And it's also inverted. Many market prognosticators talk about an inversion of the yield curve. In that instance, they're most frequently referring to the 2-year 10-year spread. The 2-year 10-year spread started the year with a positive 79 basis points, meaning 10-year bonds earned almost 0.8% more than 2-year bonds. Now those sit at a negative spread, negative 39 basis points, and that's as of 9/30, meaning that for those that use that as an indicator for potential recession, either the probability or the magnitude of recession is rising. As we move into sectors here, or kind of causes of concern, if you will, there's no question that interest rates have been the primary driver. We'll talk about spreads in a moment. But for those that do own fixed income outside of the United States, the strength of the US dollar has been a material influencer on price and price pressure in this market. And you can see it in foreign bonds, unhedged here, the influence of the dollar. Now, speaking of spread, spread is the additional yield or income that you can potentially return above a risk-free rate. So here we're talking about corporate bonds, investment grade bonds, IG, and non-investment grade bonds, also known as high yield. The light blue line is high yield, the dark blue line is IG. You can see 552 basis points or 5.52% additional spread that markets are really demanding to be compensated for taking on the potential default risk associated with non-investment grade bonds. Today, IG is around 159 basis points. Now, both of those you can see above their 10-year averages, so historical averages, but in material concern for recessionary environments, call it COVID, the Great Financial Crisis or GFC of 2007, 2008, you can see that spreads had often risen far higher, especially on high yield. So call it in the at least 700 or 800 range. So spreads are certainly widening, reflecting kind of aggregate risk. They have not been nearly as volatile as interest rates, but they're not necessarily discounting either a protracted recession, a long recession, or a material and deep recession. So, those are not being reflected today in prices, but they're certainly offering better forward-looking opportunity as we look at spreads, because all else equal, higher yields give us a better opportunity for higher future returns. As we turn to the equity market, we talk a lot about inflation. We're all reading the tea leaves on CPI here in the United States, but inflation is not just a US phenomenon, it's a global phenomenon. So 8% average country or developed country inflation rate as of the end of August. That's 5.3% across emerging markets. And what that has done to valuations globally is it has pushed down valuations materially. You can see in the US here, we went from, call it expensive valuations at the end of last year to, let's call it middle of the road here, or maybe slightly lower than median or average over reasonable periods of time. International, developed, and emerging, we basically went from average-ish at the beginning of the year, slightly expensive, to materially below average. So risk and concern around increasing interest rates and volatility and inflation have been reflected in those values. As evidence of that, there's actually 56 central banks globally that have increased their policy rate year to date, and that's had a material influence on valuations. As we turn towards sectors, we have 9 of 11 here US sectors that have posted negative returns. The energy sector continues to be a bright spot. Historical underinvestment in that sector. Obviously, geopolitical risk and volatility, both in Europe and kind of abroad, and supply constraints have pushed some of those prices higher and have produced a lot of positive earnings surprises for those businesses. And so those sectors have done well. On the flip side, you look at consumer services year to date on a technology basis, many of those growthier or more expensive stocks in a period of rising interest rates have certainly been harmed a lot more based on rising interest rates, because more of their total value offered to investors is hidden in the future, right? You have to grow into those. So as higher interest rates rise, that means those future earnings are worth less. And so those sectors have been more materially influenced by rising rates than, say, more value-oriented sectors like energy, like utilities, et cetera. Now, as we look outside of the United States, there's no shortage of things to talk about here. Europe is still reeling from kind of the reverberating effects of Russia invading Ukraine. That happens both kind of at literally the border and tangency level, from immigrants leaving the country. It's happening at the economic level through higher power prices in energy and security. Similar headlines du jour as we turn our gaze towards Asia. Specifically, we have China. China is leading the emerging markets down quarter to date and year to date, dealing with some self-inflicted issues. COVID-0 is a good example of that. Re-regulation in 2021 is an example of that. And its sovereignty with Taiwan is another example of that. But they're also facing some other economic headwinds, slowing economic growth, and they have less of a command and control economy today than they presumably had in the past. And so market prices are certainly reflecting those concerns and those risks. And you can see it in both the quarter, down almost 22%, and year to date, underperforming. And many other countries here, especially more cyclically oriented like Germany or others, underperforming. Now, what I will note also is the returns on the page here are dollar adjusted returns. So there's local market returns, and then you translate those local market returns for the change in the dollar. UK is a great example here, showing down almost 19%. UK has also had its battery of issues with a new prime minister in the mix, changing policies, concerns around their pensions. But if you actually look at the local UK market through 9/30, it was only down a little bit over 1%. All of the difference in that return is around the strength of the US dollar. So we've got a little bit more on that when we get into the why and kind of the what's happening. But we want to make the difference that it's not simply underperforming countries or markets, it's also had a material influence for the dollar. On the real asset side, again, many real assets still outperforming their opportunity cost or wherever you would invest your capital, mostly in equities year to date. But as cyclical sectors, right? Usually sectors that are doing better in an expanding economy. That means expanding demand. That means more robust demand for physical things. We've had more of the opposite type of conversation as of late, with concerns for economic contraction, with concerns for recession. So you can see that both in here with energies, but also industrial metals and precious metals as well. Finally, on the real estate side, both increasing interest rates has had an influence on that market, and then some idiosyncratic concerns here. Office is a good example of one of those year to date, where many offices, especially in larger office complexes, are still trying to exit kind of into a post-COVID period, and so you can see some of the reflected concern there across that sector. So as we transition into the why, we want to start maybe with the root of the problem. Where is this all really starting? And it's starting with inflation. And inflation is driving the Fed to take certain actions. So you can see here on this graphic, this is the Fed and its actions year to date. We certainly don't know what November and December, I think 14th, has to hold for us. But the Fed, we certainly got a little carried away with the word transitory. We're behind the curve. We were using quantitative easing techniques, a loose monetary policy up until last year, and now they're playing catch up. And so you can see one of the reasons that fixed income has had such a difficult year isn't just the change in rates, but it's the pace in change in rates relative to past cycles that's been far more drawn out. The other reason that fixed income has had such a tough year is we started with extraordinarily low interest rates low yields. Without yield, it's hard to cushion against price volatility. So the Fed they're kind of between a rock and a hard spot in trying to deal with inflation, but their September meeting and press conference after, they give a lot of clarity on the fact that they will be putting inflation first as the primary objective of the Fed, as opposed to economic growth and price stability. Those are their two dual mandates. They have picked a 1A and a 1B, and they're living into that. Now, what are the effects from a rising Fed? So we certainly know about fixed income, and we've talked about that volatility. But it's also impacted equity markets. And so here, if you think about breaking down the kind of why is the Fed influencing equity markets, there's two things to derive index price. So call it the S&P 500. You want your earnings per share. So what are those collective businesses earning on a per share basis? You multiply that number. Finance individuals came up with a great marketing name, and they called it the multiple. Multiple times earnings per share gets you your aggregate index level, and that potentially derives price return. We can see growth in earnings has been positive year to date. It's been more modest than expected. There's potential greater volatility as we come into Q3 earnings season, and Q4 are maybe disappointing. But nonetheless, the problem hasn't necessarily been earnings. The problem has been multiples. So what you're willing to pay for a given share of earnings has been contracting, and that has been driving the majority of prices as they come down. So that's why we're saying growth securities, which historically have had higher multiples, have been more acutely impacted by rising interest rates, due to the fact that that's been the primary driver of compression in prices here today. Now, U.S. is obviously being impacted, but what are the impact abroad? So we talked about how the UK local return is down a little over 1. Dollar adjusted return is down almost 19%, right? So what's the difference there? The difference is the dollar. The Fed has been, as we just showed, been very quick to come out of the gate in a big way, raising interest rates. That makes, and this is a shortened version of it, but it makes the dollar more attractive globally. So as more people try to buy dollars, that increases the price of the dollar relative to other currencies. And so the dollar has been increasing in price materially relative to other currencies. Also, in periods of volatility, the dollar tends to be the reserve currency of the world. And so people generally seek out dollars either via treasuries or other assets in periods of volatility. And so you can see the euro, the pound, the yen, the Chinese renminbi, and many, many other currencies, save for a few in Latin America, have had material depreciation to the dollar. Some of them into the 30s, right? But as we think about any asset that's owned outside of the United States and is not hedged back to the dollar, when you translate those assets back into US dollars, you've had a pretty material headwind from the US dollar. So what does this all mean? Where do we start to find kind of the why, right? So what happened, why it's happening, inflation, interest rates. That's why the market has been so focused on kind of this idea of a Fed pause. Well, if we're trying to read tea leaves around a Fed pause, one, we would say, first, don't. Just stay long-term invested. You don't think we need to focus on, this meeting or next meeting. But if we're having that conversation, part of the things we want to be looking at is the Fed's influence in the labor market. So, much to the chagrin of the Fed, who does have a dual mandate in its economic growth, and that leads to things like full employment and economic mobility and success of US citizens, unemployment remains very tight. We've had strong labor numbers here in the US. We've had good unemployment numbers. And so the ability for the Fed to hit the brakes, or I'm sorry, I guess take their foot off the brake in that analogy, how that would carry, they really need to see, or are likely going to look for, a softening in the labor market. We have not seen that yet to date, but there are initial signs of some of that. Layoffs coming from large businesses, kind of a slowing of employment, and the leading indicators around some of this data are starting to show that the Fed's tightening is having a true economic effect. Now, one of the areas we can specifically see it is around housing. So when we think about CPI is constructed, and the largest single component is shelter. Now, the Bureau of Labor Statistics uses a thing called owner's equivalent rent to take their best guess at what it costs to have shelter in the United States, because not everyone owns a home, they rent homes. Well, owner's equivalent rent and house prices naturally are very correlated. Well, if you look at the most recent print in CPI, which is September data, which occurred in October, that actually showed owner's equivalent rent rising by 0.6%, so clearly accelerating. Now, what's been happening recently with home prices? Home prices have actually been falling and falling modestly. So the effect, though it's lagged in some of the data, is starting to become material in prices. Now, here we show tightening conditions with 30-year mortgage rates. With 30-year mortgage rates at 6.75%, that's the first time we've seen that since really prior to the GFC. And so if you think about the median home price, which is around $400,000, an increase in the 30-year mortgage rate of just year to date, the moves that we've seen, that would be an adjustment of almost $900 a month in interest payments for the median home price in the United States. So that creates less demand. It potentially creates more cooling that eventually will recirculate back into things like owner's equivalent rent and hopefully slow inflation. So while it's early to see some of these levels start to fall, there is signs of moderation of inflation. And it's not just housing, we see it elsewhere. You see it in container rates for global shipping coming down very much from their highs, but even year to date, continuing to moderate. You see it in supplies of inventories starting to build, which means companies that were paying really anything to try to get goods on the shelf so they could sell them. Now they have more on the shelf and more supply, and maybe moderating demand means that prices might have to fall in order to clear inventory. So there's many places we're starting to see it, but it's really lagged in some of this rear view mirror backward looking data. So where does that leave us as we start to talk about kind of 2022 and beyond? Well, there's a couple of things that we would point to. First is fixed income is a different game today than it was at the beginning of the year. The Bloomberg Barclays Ag was yielding, less than 2 at the beginning of the year. Now it's yielding almost 5. as we talk about 930 data. So as we think about 2023 outcomes, reallocation, considering our exposure to certain fixed income assets and also what they can do in our portfolio is a very different math and proposition and frankly interest today than it was at the beginning of the year. As we look, global equity valuations now reflect far more pessimism than they did in the beginning of the year. US is still moderately priced or maybe a little below average, while as international continues to be very attractively priced. Now with additional concern, right? So as we look towards 2023, weighing opportunity evaluation relative to some of these more meaningful and material potential concerns in emerging markets. And then when it comes to real assets are likely going to be a staple in portfolios for quite some time. We at Fiducient had owned real assets for a period of time well before inflation was the hot button word. But we think it's unlikely that if we go from, call it 8.1% headline inflation in September of 2022, we're not likely just going to drop straight back down to 2% over the long term. And so the ability to see and moderate portfolio volatility as inflation is falling, but likely going to have fits and starts in that path. Real assets are going to continue to play a material role, but the mix of them may change over time. So fixed income far more attractive than it once was. US equity valuations reflecting far more better outcomes in the future, and the materiality and importance of real assets are the three things that we would leave you. Now, as we get towards year end 2023, or 2022, we will be looking forward to 2023 allocation changes, our outlook, et cetera. All of that comes in November and December, so just around the corner there. But needless to say, today, more opportunity than there was at the beginning of the year, and we're far more excited about allocations. Should you have additional questions or comments, please feel free to reach out. We recognize that it's a volatile market, it's a volatile economy, there's a lot of headlines out there. We're always here to help and answer any questions that you might have. Thanks again.